Hello, investors. Again, I'm very glad to see you, and I hope you're glad to see me. My name's Joseph Areu, and we are here to talk investments. We are here to help ourselves improve on our financial independence, to make sure that sooner or later we are able to grow our wealth and become financially independent. I hope that all the sessions I've had with you so far have helped you to do that. Always remember to subscribe to this channel, and that way you'll be able to get all the notification of all the videos that will be posted. In the last discussion, we were talking about dividends. Once again, this is May, this is the second quarter, and very exciting time in the shares market or the stock market, because in our region at least, most of the companies have declared dividends at this point in time, or they are declaring dividends at this point in time. And the idea of buying dividends for me is essentially to improve on your return. If you are like me, I like to buy companies or to buy shares which pay a dividend regularly, and that gives me a higher return on my investment. So today I want to talk to you about returns. Specifically, I want to talk about what we call total return, the total profit, if you like, that you get on the profit, rather, on the investment in your shares. Many times when we talk about returns, we are talking about, or we are told, it is the improvement or the growth in the price of a share over time. But that is just half the story when it comes to the return on a share. Potentially, returns on a share investment come from two sources. Firstly, there is the capital gains return. Capital gains means the price of the share. So as the price of the share goes up, hopefully, you are gaining a return. So when you sell that share, then you will sell it, of course, at a profit. So that gives you a return, capital gains. Secondly, there is what we call, of course, there is the dividend. Okay? So if the company is paying a dividend, then the dividend becomes an additional return that you can enjoy as a result of investing in a share. So the total return is a sum of those two returns, the capital gains plus the dividend. The capital gain return would be measured by the rate of growth in the share price. So if from the beginning of the year to the end, the share price went up by 10% or by 5%, then that is the growth rate. So that's the return you've earned with regard to capital gains. The dividend return is measured by what we call a dividend yield. Okay? The dividend yield is calculated by dividing the dividend amount by the price of the share and multiply by 100 to give you the percentage. So if you add the two, then you get what we call the total return. So why is this important? It's important to know the total return to be able to select companies which will maximize, or shares that will maximize your return over time. Again, like I said, if you're like me, I definitely I prefer to buy companies or buy shares that give me a decent dividend yield over time. So if you are able to reinvest that compounds your growth even further. So always try to look out, try to calculate, try to determine not just the return. Like I said, most return data that you will read about, in the press, are likely to be just the capital gains. However, I'm saying to get the full picture, add to that the dividend yield, and you can always get that information, historical dividend yields, from your broker, from the press. So add that average dividend yield per year to the capital gains in order to get a good idea of what the total return is going to look like. Of course, the higher the total return, the better. That goes without saying for all of us. So I would like to illustrate for a few companies that are in our regional market, in this particular case, the Nairobi Securities Exchange. And so I will just look at 4 companies which have declared dividends. Some of them have already closed their books, so they are now waiting to pay. For some, the books might still be open, but you can check that with your broker. So if you look at Cooperative Bank of Kenya, about 1 year ago, a share of Cooperative Bank was going for about 12.4 shillings. Today, as I'm talking to you, it's about 12 shillings. So unfortunately, the capital growth, the price has gone down by about 40 cents. Okay, meaning the capital growth rate is about minus 3% in a period of 1 year. However, the company declared a dividend of 1.5 shillings. Okay, so if you take that dividend and you divide by the opening price, then you will find that the company has declared or is giving a dividend yield of about 12%. All right? So the total return, therefore, is a sum, as I said earlier, of the capital growth rate and the dividend yield, and that comes to 9%. Okay? That comes to 9%. We look at another company, and that is NCBA. That's another bank, right? At the beginning of about 12 months ago, that's about a year ago, NCBA's share was going for about 29 shillings 95 cents. This is Kenya shillings. Around about the time I am presenting this to you, it's about a couple of days ago, a share of NCBA was selling for 33.9 shillings. 33 shillings, 90 cents. So in about 1 year, the share of NCBA has gone up by 7.95 or 7 shillings 95 cents. That gives us a capital growth rate of 31% in a period of 1 year. Now, in that same period, NCBA has declared a total dividend of about 4 shillings. Okay? That gives us a dividend yield of 15%. By the way, so this NCBA's declaration of dividend happened twice. They first declared a mid-term dividend, and then they have just declared like a final dividend about a month or so ago. So that the total during the year comes to about 4 shillings, giving a dividend yield of 15%. So if you look at the total return for NCBA, it is 46%. That's quite good if you ask me. Next, let's look at the REIT, Real Estate Investment Trust, in particular, the one we call the Fahari REIT. You can always ask your broker about that. About 12 months ago, a share was going for about 5 shillings 74 cents. The closing, the price about 2 days ago was about 6 shillings. And that gives a capital growth of about 30 cents. A capital growth rate, therefore, of about 5%. The company or the business declared a dividend of 65 cents some 2 months ago. And that gives a dividend yield of 11%. So the total return that you would get by investing in that REIT, assuming you invested, of course, about 12 months ago. I mean, these numbers, of course, will be adjusted depending on when you invest. But for purposes of this, we assume you invested about 12 months ago. You will be enjoying a total return of about 17%. That is another fantastic return. Finally, let's look at equity. About 12 months ago, Equity Bank shares was going for about 44 shillings 95 cents. About 2 days ago, it was selling for 42 shillings 40 cents. You can understand that these numbers are coming at a period when there's quite a bit of market volatility, so prices have been depressed. Otherwise, these are all basically very good companies. The capital growth, therefore, has gone down. The share value has lost 2 shillings 55 cents, giving us a capital growth rate of -6. However, the company declared a dividend of 4 shillings per share, and that gives a dividend yield of 9%. Very good dividend yield, if you ask me. And so if you add that dividend yield to the capital growth rate, you end up with a total return of 3%. So one thing you can see here is that even if the price of a company's shares has gone down, it doesn't, and therefore it's showing a negative capital growth rate, it doesn't necessarily mean that you will earn nothing, especially if the company is paying a dividend. Your total return, depending on how much dividend has been paid or the dividend yield that has been provided, could still be a decent return over time. So I hope this is useful. Always think in terms of not just the capital gains, but also think about the dividend yield. When you add those two, then you will get the total return, and that would be the more indicative, the more useful indicator when you're trying to assess or evaluate shares or different companies in terms of which one you want to buy. And this information is available. You can ask your broker. If you read in the financial press, you should be able to easily get this information to be able to inform yourself about the total return and therefore the value that you're likely to get by investing in shares of any given company. Thank you very much for listening. I look forward to talking to you again. Thank you.